Hey everyone, welcome back to Watch Your Six. I'm your host Jason Edwards, glad to have you here. Hope you had an exciting week. We're going to have some really cool stuff we're going to talk about in this podcast, but before we do, I thought it'd be interesting to go back over the last couple of months and highlight some of the things that we've discussed and to show you how our forecasting has sort of been on point. Remember the Bitcoin conversation we had? We actually had a whole episode about Bitcoin, how concerning Bitcoin was to me. Number of reasons was, one, volatility, the ability to lose at a very fast pace. Two, the inability to really forecast because there isn't a company or a country or something that you can look at from their fiscal perspective to determine why or what's going to happen there. Well, what's happened? Well, if you've been in the Bitcoin or if you've seen the crypto world, we've seen it sort of collapse very quickly. So you've had dramatic losses if you've had things like, for example, Bitcoin. You've seen dramatic recessionary issues. And that's what we highlighted. Some of the concerns and the things that we thought were areas you want to be scared of exactly occurred the way we forecasted. So we're not saying that we have a crystal ball, but we are saying to pay attention to some of our podcasts. Look at and really take to heart some of the things we're discussing because it can prevent you from impacting yourself negatively and ultimately save you lots of money, and that's our goal. Remember, our goal is to watch things that you're not aware of, and that's why we use the term Watch Your Six. We also talked a little bit about some of the other areas we thought that were going to do really well. Talked about the U.S. market domestically and how things are going to expand. We're seeing that dramatically, and we're going to talk a little bit more about that today. We're going to get into some of the ripple effects that we think they're going to happen forecasting for 2026, but we're starting to see some of that come to fruition. So again, market investments and market in timing takes time, and I hate to say it that way, but the reality of it is you have to be patient and you have to have a comprehensive plan set up. Otherwise, you're going to do one of two things. You're going to react too quickly or react too slowly, and either can impact you negatively. We also got into a little of the other areas that we thought were really working, like natural earth, semiconductors. We're seeing a huge purge there, and we're seeing a huge influx of capital going into other areas. And we're also seeing market expansion in some of those areas. So today we're going to talk a little bit about that. We're going to talk a little bit about something called alternatives. Now, alternatives are something that you may or may not be familiar with, but many people will ask us, hey Jason, what are the uber wealthy or the jumbo rich, so to speak, what do they invest in? What do these large private equity firms invest in? Now remember, when you have a certain amount of capital, it does give you access to things that the average person doesn't have access to. And with our firm, sometimes we have access to that for our clients, but there are a space in our world called alternatives. And the reason they use the term alternatives is because, like it sounds, it's an alternative to traditional investing. Why do I say that? Well, when you invest in any type of investment, there are benchmarks. There are status quos. There's a thing called a beta, and a beta is really just a ratio that says, how will my investment act as it relates to the stock market? And there's an alpha. That's another ratio that says, how will my investment grow? These are all terms that we use in our industry to help dictate volatility. Now, when you invest, you're always trying to do better than what the market does. And one of the ways to mitigate some volatility is to look to invest in what they call the alternative space. Now, the alternative space, as by definition, is an alternative or a market that will react in contrast to traditional stock market. So when a stock market starts to crash and drops 40, 50%, an alternative in that particular sector may go up 5% or may be flat. So it's acting in direct contrast to traditional markets. So alternatives are a very unique investment opportunity that are available that many people aren't aware of, and rightly so, because in some cases there's a $2 to $3 million buy-in for alternatives. Now, there are accesses to that through our firm and through other firms if you're looking to invest, but alternatives are a nice way to mitigate some of your risk. Now, examples of alternatives might be something like a private equity fund. Why is that? Well, that is not dictated by the market, that's dictated by acquisitions. So a private equity firm is dictated by, an entity buying one company and maybe selling the company for 1% to 2% and making billions. that has no tie to the stock market, that has no tie to the economic environment, depending on the sector. So alternatives are a very unique investment model that do exist. And if you have an investment team, ask your planner, hey, what kind of alternatives do you offer? What are some of the alternative investments that you have available? If they don't, maybe go to a different firm. You're welcome to call our firm, but you always want to look at having alternatives as part of your portfolio because it's a nice way to ride out the waves. It's a nice way to mitigate some of the volatility in a portfolio, especially if you're trying to be a little aggressive, if you're trying to look for growth. Now, I would never recommend doing more than 5 to 10% of your portfolio in alternatives because the portfolio yields in some cases could be flat, and in other cases you may not have phenomenal growth in a bull market, but it is a nice place to look. So keep your eyes open. It's a term you can use with your planners. Ask them about alternatives. There are things like REITs, real estate investment trusts, that can fall under alternatives. There are muni positions that can fall under alternatives. There are, as I mentioned before earlier, private equity positions that can fall under the term alternatives. But alternatives by itself, it's a whole sector. And it's a whole unique sector of investments that allow you greater potential and protection against volatility. So give that some thought. Think about that. Do your research. If you would like, again, you can go to our thejasonedwards.com, get our ebook. Talks a little bit about some of these alternative investments and gives you some more information. And again, that book's free. But I would strongly recommend that you look into the alternative space. It's an area that's very rarely talked about, and it's an area that's very rarely offered. In fact, a lot of financial planners or advisors don't even know about them. But that is something that is very critical if you want to make sure that you're making money in all sectors, and you're making money in all market environments, and you're making money in all market capitulations or market adjustments. Now, why is that critical to your overall portfolio? Well, you have to be prepared for what's going to happen, not for what has happened. Remember that when it comes to investing. You're always trying to forecast a little bit of market growth and market adjustment. You don't want to react to a market, you want to be proactive. So when we think about that, 2026 presents some really unique opportunities. We talked about in a previous podcast because of what we're seeing unfold. Do you realize that the GDP, that's the gross domestic product, that's the way you track how a country's economy is doing? They are speculating that our GDP for the first quarter is going to be 5%. That is an astronomical number. I can't stress that enough. May not mean much to you, but from an economist perspective, a 5% GDP for the United States market is unheard of. We haven't had that in 100 plus years. Now, when that kind of positive data comes out, what do you think the reaction to the stock market will be? Well, it's going to be dramatic, because people invest with their emotion. So you're going to have influx of tremendous capital. Some other things that are really drawing into a strong stock market is the reduction in oil costs and transport costs. If you notice now, the national cost for gas is below $3. We're looking at about $2.80. That is the lowest it's been in almost 5 years, 6 years. With that reduction in fuel, I want to explain to you basic economics and how that ripple effect has an impact. If fuel costs come down, the cost for a train, the cost for a truck, and the cost for a plane goes down, right, to run them. That's transport costs. When those transport costs come down, that means the cost to the vendor, the cost to the cereal company, the cost to the steak company, the cost to any grocery companies, their cost to transport their goods is going to come down. When their cost to transport goods comes down, their cost to produce goods comes down. When their cost to produce goods comes down, their cost selling it to you, the public, eventually will come down. Now, there's no doubt that as these costs come down, some of these companies may be slow because they get greedy. They're like, man, I can make some money back from COVID, or I can make some money back from when I had to raise employee pay to keep people employed. So there may be a little bit of what we call greedflation. We've heard that term before. But you're talking about a massive ripple effect. And that ripple effect will not just be geopolitically centered in the United States. You're talking about globally. Because regardless of what people think about fossil fuel runs the world. Ships don't run on solar power. Airplanes don't run on solar power. Trucks don't run on solar power. Trains don't run on solar power or windmills. So those entities all run on fossil fuel. So when we see an aggressive campaign to get the cost of fossil fuel down and the cost per barrel is down, that is going to have a huge impact on the cost of goods. So whether you like it or not, that impacts your groceries. That impacts your ability to get products. Many of those products are made from petroleum-based products. So all of that has an impact on us. And then when you add things like natural gas, which is another way that some of these institutions transport goods, you're going to see a huge impact on the economy. Now, on the U.S. side, another thing we're seeing due to some of these tariff-related decisions is companies and countries are moving manufacturing plants back to the United States. We're seeing a huge influx of capital building manufacturing plants. Why is that important to you and me? Well, most of those areas are going to be areas that have been somewhat hit in the past. So you're talking about your South Carolina, North Carolina, Midwest. So now when you start seeing these manufacturing plants come back online, you're talking about salaries. And those salaries, again, have a ripple effect. So if I have 50 to 100 to 200 to 300 people getting jobs of 70,000 to 100 grand, what's the ripple effect? Well, they get a house, they get an apartment, they go out to eat, they buy coffee, they get groceries. All of those institutions make money off of that one manufacturing plant. You add 200 to 300 manufacturing plants, you're talking about a tremendous amount of sales tax for the states. You're talking about a tremendous amount of revenue for the consumer companies or the providers, dry cleaners, grocery stores, restaurants. So you're talking about a revitalization of the middle class. And the middle class is what traditionally drives the U.S. market. So you've got all of these very positive things that are coming on the front here. And that, coupled with some of the other things that we see that could happen in the next couple of months, position us very well. But again, it comes back to the thing we always say in our Watch Your Six podcast. If you're not invested in the market, what are your chances of growth? If you don't take the time to sit down and finally get in your situation structured in a way that you're positioned positively, what are your chances for growth? They're non-existent. Now, another thing we've talked about in the past, and we mentioned in our previous podcast, how to invest in AI. AI is a unique animal. It's expanding so quickly that most people can't keep up. But some of the things you can think about, we talked about, are the ancillary parts of AI. One of the biggest things with AI is that you have a huge need for storage space, and you have a huge need for power. So when you start to think about investing, instead of just investing in AI entities, you look at the structure or the infrastructure for those entities. So for example, semiconductors, we've talked about that before, really hot market. But you also can look at things like scanning and storage facilities. You can look at things like alternative energy, nuclear power. I mentioned natural gas. These are areas that are going to be used heavily to create power supply for these institutions as the AI becomes more and more prevalent. The support systems, the mechanics, because this market of AI is going to become something that is more broad spectrum than people think. We talked in our previous podcast how even companies like Walmart now are putting robots and AI in their facilities to cut back on labor costs. And that is a marketplace that's going to happen. Now, the flip side, though, is as you need more AI and more robots and more semis, you're going to have more skilled positions. So those individuals that may lose their jobs in one place might have opportunity to get a better paying job in another if they're proactive and if they look into ways to invest in their education and get trained on these marketplaces. So with this market environment, it's very unique. It's very fluid. It's moving at a pace that we haven't seen in years, but it is very robust and presents incredible opportunities. So take advantage of that. Be excited about it. If you don't have a plan, get a plan. If you haven't sat down with a financial team, get your financial team. If you're starting to invest, double down on your investments. But make sure you're doing it with a sound strategy that you really know what's going on. And that's the way you want to structure yourself. So hopefully these things have sort of got you excited for the upcoming year. In the next couple episodes, we'll talk a little bit about some other specific marketplaces and some unique tricks that we feel that are beneficial. But remember, if you don't plan to fail, you fail to plan. It's vice versa. You need to sit down and make sure that you walk through with a financial team the detailed ways that you want to enhance your growth. Whether you're trying to build a company, whether you're trying to build financial wealth, whether you're trying to enhance and maybe sell a company. It's called succession planning. You got to have a strategy, and you got to look at the pros and cons of everything to ensure you're in the right position and that your team has got you positioned so you can take advantage of it and not surprised by some sudden adjustment or item that you didn't look at. Anyway, we'll be right back with Jason's Fast Five. I'm Jason with Watch Your Six, and thanks for tuning in. Hi everyone, I'm Jason with Watch Your Six, and we're back with Jason's Fast Five. We got some interesting information that we see coming up here. Talking about Bitcoin, again, I hate to always beat up crypto, and I know I always talk about some of the reservation, but it's the lowest it's been since November 2024, down 14% over the last month, and it slips out of the top 10 most valuable assets by market cap. So that will tell you why you have to be careful with crypto and don't fall in love with returns, because returns, depending on volatility, you can lose them very quickly. Silver fell 23% over the last 5 days, from $119 an ounce to under $90 an ounce. Now this is interesting because silver and gold had a huge run up, and people got excited because those are resources that are used for the AI space, but it shows you how the historic months-long rally has basically come to an end for both silver and gold. So I wouldn't necessarily get overly excited about dumping it, but I wouldn't look at reinvesting right now, because after pre-flip, 5-year return on gold outperforms Bitcoin. That's a good thing. But again, we're talking about that momentum shift. And that happens with things like natural earth or natural resources. People fall in love, it gets flooded, and then it dumps. So I would just say maybe stay a little bit neutral when it comes to that. The S&P, some of the biggest moves included Starbucks up 2% and Intel was up 10%. So this shows you how some of these ancillary pieces, Intel particularly, is a supporter of the AI space, right? You're talking about space, you're talking about storage. So you're going to start seeing some of those entities, like we touched on our podcast, may start to spike and grow, and that's really unique. Now Tesla, you can see a shift in Tesla's model. Tesla is retiring the Model X and the Model S to make way for robots. That shows you that Elon feels robots are the way of the future. So they will stop manufacturing both the Model X and the Model S by the end of June, and they're going to restructure their factories in Austin, Texas to be able to expand their programs to create more robots. So that is a space that you might want to be looking at, because if you've got large institutions like Tesla restructuring their plants to push, that's something that they feel is monetarily beneficial and useful. Again, another area you want to stay on the front of, and make sure you keep aware of that. Talk to your financial team, see if there's any area or spaces might work in your portfolio. As always, we recommend you go to thejasonedwards.com. That's thejasonedwards.com. Get our free ebook. It's a really beneficial tool we put together. It's comprehensive, gives you some really good cheat sheet as it relates to investing. I'm Jason Edwards with Watch Your Six. We look forward to seeing you back here next week. Have a great week and talk to you soon.